Inverse head and shoulders is taught in every technical analysis course as the bullish counterpart to the regular head and shoulders pattern. Three lows, left shoulder, lower head, higher right shoulder, neckline at the highs in between. Theoretically, the pattern signals a reversal from downtrend to uptrend. In practice, most inverse HNS patterns retail traders identify never resolve correctly because the structural and volume rules that define a real inverse HNS get ignored. Today, the four rules that separate a real inverse HNS from a wishful drawing: the volume signature that confirms accumulation on the right shoulder, and the neckline break entry that turns the pattern into a tradable signal. Here are the four rules. 1. Prior downtrend. The reversal pattern needs a trend to reverse. An inverse HNS in a sideways market is meaningless. 2. Volume peaks on the left shoulder. The left shoulder represents the last meaningful selling. Volume should reflect that with the highest reading in the pattern. 3. Volume expands on the right shoulder. This is the diagnostic rule most retail misses. The right shoulder, while making a higher low than the head, should print on expanding volume, institutional accumulation showing up. Without this volume signature, the pattern is just 3 random lows. 4. Neckline break on expanding volume. The breakout above the neckline must come on real participation, not on a thin bar. All 4 required. Watch this in a synthetic chart. A trader spots a 3-bump structure that looks like an inverse HNS, left shoulder at 95, head at 88, right shoulder at 92. They draw a neckline at 105 and wait for the breakout. Volume is flat through the entire pattern, no clear peak on the left shoulder, no expansion on the right, no surge on the neckline test. When the breakout fires, it's on light volume and fails within bars. Same trader treating this as a real pattern took the long, got stopped out. The structure looked right, the volume profile said the pattern wasn't real. Without volume confirmation, 3 lows are just 3 lows. Here's the key. The right shoulder volume signature is what separates real reversals from random patterns. As the right shoulder forms a higher low than the head, volume should visibly expand compared to the head's bars. That expansion shows that the buyers absent during the head are now returning, accumulating positions at higher lows. Without this volume tell, the higher low is just a higher low, could be a counter-trend bounce that resolves back to new lows. With it, you have institutional confirmation that the reversal is real. Apply the volume test ruthlessly and most apparent inverse HNS patterns disqualify themselves. Now with the textbook pattern. Prior downtrend established. Left shoulder forms on heavy selling volume, the last big sell. Head makes a deeper low on declining volume, sellers running out of pressure. Right shoulder makes a higher low than the head, and crucially, volume expands. Institutions stepping in to accumulate. Neckline break candle fires on a sharp volume surge confirming the breakout. The trader enters long on the breakout, stops below the right shoulder, targets a measured move equal to the depth from head to neckline. All 4 rules satisfied. The pattern works because the volume profile said it was real. In practice, before shortlisting any inverse HNS, check the volume bars at each of the 3 lows. Left shoulder should be the heaviest. Head should be lighter. Right shoulder should show clear expansion, visibly higher than the head's bars. If that profile isn't there, the pattern isn't real regardless of how clean the shape looks. Apply the volume test consistently and you'll find 1 or 2 real inverse HNS patterns per stock per year. And those 1 or 2 will deliver the historical edge the textbook promises. Subscribe for the full method and trade your own plan. Education, not financial advice. So, a real inverse head and shoulders requires a prior downtrend, peaking volume on the left shoulder, declining volume into the head, expanding volume on the right shoulder, and a neckline break on volume. The right shoulder expansion is the diagnostic rule most retail misses. Apply the volume test consistently and only trade the textbook versions. Subscribe for the full method and trade your own plan. Education, not financial advice.